Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews. I'm joined by Matt Whineray, who is the Chief Executive of the New Zealand Superannuation Fund. Welcome into interest.co.nz, Matt. Thanks for joining us. Now, you've had your annual report out this week, and in that annual report, you've got a very interesting section where you say the fund would lose about $20 billion, which is about half the value of the fund at the moment, if a global financial crisis type scenario were to hit today. Now, very interesting that you've come out and said that, and obviously it's coincided, which wasn't planned, with a rocky period in the markets. But I guess the first question there is, are you expecting another GFC? And if not, why have you said this? And then I guess second part of the question is, I'm just interested in, is there any pressure on the fund to move away from the focus you have on equities or growth assets? And if so, where might that be coming from?
I might answer the last. But first, actually, there isn't any pressure on us to move away from our asset allocation. One of our four endowments, one of our critical endowments or advantages that we think we have is that we have operational independence. So yeah, critically, there is no pressure on us to change our asset allocation right now. If we go back to that section in the annual report, what that section is called volatility and risk, understanding the difference. And what we're trying to do with that is say, look, we make a choice in terms of our portfolio construction, and our choice is to take a reasonable amount of market risk. That's 80% of our reference portfolio comprises growth assets, so equities. We do that because we have a long horizon. So at the moment, we're not expecting to have any sustained withdrawals for more than 30 years into the 2050s. And that allows us to look through the short-term fluctuations and earn that premium over time that you get paid for owning equities. But you earn that premium because you're there able to weather the ups and downs along the way. So that's what volatility is, and we're just saying, look, our portfolio comes with a reasonable amount of volatility. We look like an aggressive KiwiSaver fund. You should expect to see that sort of movement in the market. Risk is different. Risk is often conflated with volatility because you'll hear financial reports and they'll say VIX today, which is a measure of really short-term 1 month volatility, is up. So markets are riskier. But for us, risk is different because for us, the risk is not that we see volatility. We know we're going to. That's an outcome of the choice that we've made in terms of our portfolio. The risk is we don't have the discipline or the capabilities or the support from our stakeholders in a broader sense. Stakeholders are government, media, public, that we don't have the support to hold the course on our investment strategy. And so that's the distinction I'm trying to make with that. So I'm not trying to freak everybody out with the maths of the GFC, and that's just all it is. This is application of maths. It's a recent event. It's in people's memories. We're a lot bigger now than we were then. We're about $40 billion now. We were about $14 billion then. And so I just want people to understand we've made this choice. It comes with these consequences. We've made it for a good reason, which is we will earn more over time as a result of that, but we've got to be able to hold the course. And so I want everyone to understand that that's our risk. The risk is that you cannot see through the short-term stuff to be able to earn the long-term returns. Okay.
I mean, obviously, as mentioned in my first question, we've had a rocky period in the markets this week, which obviously you didn't know was going to happen when you were writing that report.
No.
But you're not anticipating another global financial crisis type scenario at the moment.
No, we're not actually. Sorry, I missed that first bit of your question. Yes, we are not predicting or forecasting another financial crisis. What we've done with this is just use that particular scenario as a way of illustrating volatility that could occur. It's a very low probability potential outcome, but it is still an outcome. And there are a range of outcomes that we will see. And you've seen that with our returns. So this year, our returns were a bit over 12%, nearly 12.5%. Last year, they were nearly 21%. Year before that was 2%. So you already see that in the profile of our returns, that there's some fluctuation.
In that scenario that you paint, you talk about how you would regain the losses within about 20 months. How would that work?
So it happens in two ways. So first of all, that is what happened during the GFC. So we say in that note, the GFC was sort of interesting in the sense it was a really sharp fall and a reasonably rapid recovery. So March 2009 was the low point. But by our balance date in June 2009, the markets had recovered a lot. So actually, the number that you see in our returns is only minus 22%, even though if our financial year hadn't to be March, it would have been quite a bit bigger than that. So it's just an accident of where it falls during the time. But the recovery comes from two things. One is we recover as markets recover. So our biggest risk exposure is still equities. We rebalance along the way so that we try to maintain a target risk and maintain that portfolio at that 80-20 mix. So as equities fall, you'll inevitably buy more equities to get to that. As equities fall a bit more, you'll buy some more. And then what you want to have is that constant risk so that when the markets do bounce or recover, whatever that looks like, you will still have that risk exposure on. So that's one thing, is that you get the market recovers, that improves the value of the portfolio. The second thing that happens is that we are, in our strategic tilting strategy, buying equities as they fall, because we'll have a view on what the long run fair value of equities is. As it falls below that, we'll buy some. Falls a bit more, we'll buy some more. And we're not trying to pick bottoms here. We're just doing it on the basis that over the long run we think that there will be some mean reversion. And so what happens in the recovery phase is that those extra equities that we've bought, they rally as well. And so what it shows in the annual report is the portfolio benefits from the growth in equities values, but we benefit more than that. We recover our lost value add, and in fact start making some additional value add, and that gets us back there. In that case, in 20 months. Now, I do stress that not all crises are the same. The next one will be different from the last one. It's like, we're always preparing for the last war, aren't we? So the next one might be slower. The downturn might be slower. But our belief is that over the long run, you get paid for owning equities, and the reason you're getting that is because you can weather the risk of the movement from the daily ups and downs, the volatility.
I guess the recovery could be slower too, and we put a story up yesterday on these comments in your annual report, and some of our commenters were making the point that if there were another crisis like that today, central banks wouldn't be in a position to cut interest rates to the extent they did in 2008, 2009, and they wouldn't be able to pump as much liquidity into the market, so recovery could be slower.
Oh, look, there are so many variables in this. I absolutely take the point that the next one will be different, and your starting point will be different, and your starting point in terms of the leverage in the financial system will be different. So there's a lot of different variables. We're not trying to forecast a crisis. We can't do that. We certainly can't try and forecast the shape of what that will look like. I think there's just markets are complex adaptive systems. They'll be the aggregation of everybody's choices. So we can't do that. We totally accept that things will be different. We totally accept that interest rates start from a lower level. And what we need to do is be resilient. So what we do in response to this is say, well, we're going to maintain a bit more liquidity in the fund. We're going to hold higher levels of liquid assets than we might on average, and we will end up with a fund which has less active risk. And for us, active risk is the difference between our actual portfolio and reference portfolio. And the easy way of saying that is we just think there's less opportunities to step away from it. And so we do two things. We've got more liquidity available and we've got more active risk available. And that does a couple of things for us. One, it allows us to weather the storm, whatever form that storm comes in, but we can make sure that we can survive the storm. And the second point is it allows us to take advantage of those times when markets are, panicking and people are selling. We don't have to. And that's really important. That's our key endowment as a long horizon investor. Don't ever be forced to sell.
Now, next year the fund is due its 5-yearly independent review too. Mm-hmm. Will that look at your focus, the focus on growth assets? Will that be part of that review?
Yeah, look, the Treasury is just producing the terms of reference for that at the moment, and there's some provisions in the legislation that say this is the thing. These are the core things that you have to look at. Do we have the appropriate policies? Are they being applied? Are we efficient, effective? Blah blah. But there are other things that the Treasury will look at. They will look at the reference portfolio framework, and that obviously contains this choice of asset allocation and how we calculate performance, how we measure risk, that kind of stuff, and that'll be part of it. So I'm hopeful actually that we get. This will be really interesting for us, that we get someone to come and do this review who has a really good understanding of other funds around the world and can give us a really good sense of where we are versus those guys. Not just in terms of performance, you can do that outside, but in terms of how we do it, how we operate, how we think about investments, how do we make investment decisions, that kind of stuff, I think is going to be really helpful for us.
You don't know yet who will do the review?
No, they haven't appointed anyone. That'll happen at the start of next year.
And they're appointed by Treasury?
Treasury appoints them, yeah.
Okay.
Yeah.
Now, after 8 years of no government contributions to the fund, they resumed last December with $500 million.
Yeah.
Has this changed how the super fund operates at all, having government contributions once again?
Oh, look, we're very pleased that they've turned back on. They didn't give us a $500 check all in one go. They smoothed them out over the months from December to June, and then they have now stepped up so that it'll be $1 billion in this coming year, and then it'll slowly rise to what the legislation requires it to be, which is roughly a couple of $1 billion a year. It's great. I mean, it's fantastic for morale. That we have a sponsor that is confident in us to continue to invest. We're very pleased with that. Doesn't change what we do at the moment because of the way we construct the portfolio. We've got a core passive reference portfolio. Those monthly checks that come in, and now they're about $89 million a month we get. We can invest them in a very low cost way into the reference portfolio, and then over time, as we're rebalancing or we're investing in new active investments, then we'll sell down a bit of the reference portfolio and fund those things. So it's very easy for us to incorporate it in it. One of the things that it has prompted for us, though, is if you get back to the legislative run rate of a couple of $1 billion a year, and touch wood, we continue to make reasonable returns, we will grow. We'll grow a lot faster. So from 40 billion now, you could easily see us being 80 billion in 6 or 7 years' time. So that poses questions for us, which are, what would we do at 80 that we wouldn't do at 40? What might we not do at 80 that we are doing at 40? So do some markets have constraints? Do some strategies have constraints? Does the larger scale mean that we can do some things in-house that we might currently do externally? So we're having that discussion at the moment. That's a good strategy discussion to have with the board and the team, and we'll just work through that in the course of the next sort of 6 months or so.
Now, the 2017-18 year, you had a return of 12.43%, which is after costs and before New Zealand tax.
Yep.
What's your expectation for the 2018-19 year, which you're in now?
So we have to produce one in our statement of performance expectations each year. We're not in the market in the business of providing sort of 1 year forecasts for these things. We have a long run equilibrium forecast, and the way we build that up is we say what are base rates, what is our long run view on NZ cash, plus what is the long run view on the risk premiums from the risk assets that we have. Plus, what do we think we can add as the guardians in terms of value over that? And where that maths comes out to is, roughly 8.5% on a long run equilibrium basis. We're not managing the fund to try and maximise it at the end of each year. We have longer horizon ones. This artificiality of on the 30th of June we're going to take a photo of the portfolio and say what was that photo look like compared to last year's photo. We're thinking about those much longer horizons, so we implement strategies that manifest over those longer horizons. The market will give us whatever the returns are inherent in the reference portfolio. We've got a number of other strategies, including strategic tilting and our other active strategies, where we would expect over time to add about 1%. So that's our value add on top of managing the portfolio as efficiently as we can. So try not to give these 1 year forecasts. The market from the 1st of July to a few days ago, market's been up, portfolio's been positive. market's fallen out of bed in the last couple of days. So, I think it's just kind of, for us anyway, not a particularly useful exercise to go and do these short-term forecasts.